On this video is Saturday 30th March 2013, bit of a grey afternoon here on the island of Kauai, but we're expecting a swell, should arrive kind of overnight, so it should be good surf Sunday, Monday. But in the meantime I thought I'd do a video about trends and the US dollar, talk about one of my kind of pet subjects, which is the bullish case for the US dollar. But I'm not going to do it kind of in isolation, just talk about the US dollar alone, because that's not much good to you. What I want to talk about is determining trends and multiple time frames and how to use the better sine wave to figure out, kind of these bigger kind of trending moves. So what I'm going to do is just going to talk about better sine wave on multiple time frames first of all, and then kind of go into the US dollar chart. So to help me, I have just pulled up this little kind of 4 multiple time frames here for the Japanese yen. Japanese yen's been in an extraordinary kind of downtrend since the end of last year, kind of October-ish, fell into a downtrend. It's been a big move, and you can illustrate it here on multiple time frames. This is what I want to talk about. So first of all, just set this up in terms of 4 different time frames, lowest to highest, and starting with an intraday chart, a 460 minute chart of the Japanese yen here, and then bumping that up, the next time frame up is a daily chart. So I use roughly a multiple of 3 between time frames. So 460 minutes times 3 gives you roughly a day's session. So in terms of total trading, there's about 3 460 minute sessions, if you like. Daily time frame up to the weekly time frame. We use a weekly time frame just because ideally it would be a 3-day chart, but that's not possible in TradeStation, and the easiest thing to do is just use the weekly data as a proxy, and then 3 times that kind of gives you the monthly chart. Again, it should be 4 and a bit kind of times the weekly data, but it's good enough. It's kind of it's quick in terms of loading charts. You're not loading kind of multiple minute charts and so on, and that's an easy way of looking at 3 or 4 different time frames together. So lowest time frame, daily, weekly, highest time frame, monthly time frame, so you can look at what's going on in the wider context. Now, what I put on here is the regular version of better sine waves. That's what's plotted on each of the time frames. Better sine wave doesn't have any inputs. It's just canned indicators straight out of the box. Bang! It's all kind of ready done. You don't have to optimize or figure out any kind of input settings or anything like that. The only thing I have done is I've got a little kind of version of this that I like as a paint bar, and you could easily kind of code this using the functions in better sine wave. But all I do is plot kind of up and down trends based on the support and resistance levels. The support and resistance levels that better sine wave plots are really important. So if the market is above a support level or above a resistance level, so above a resistance level it's broken into an uptrend. If it's above a support level, it's in a cyclical uptrend. I paint that as a red bar, so showing an uptrend, if you like. Then the reverse is if I have a close or a bar is below a resistance line or below a support line, I paint that as a white downtrend. So below a resistance bar, it's kind of in a cyclical down move, and then if it's below a support level, it's broken into a downtrend. So quite simple, kind of just gives you an indication of kind of bigger picture trends and so on. And the point I want to make about using better sine wave and these support resistance levels is that trend moves percolate through time frames. They start off in the lower time frames, and then they get kind of picked up in the higher time frames, and they gradually kind of percolate through. So we've got a beautiful case of Japanese yen. I'll show you this over the last several months. So you can see since October-ish last year, we've been in a downtrend. Here's the monthly chart of the Japanese yen. It started off with us starting to break into downtrends on the lowest time frame charts. So you kind of go back into that kind of time frame. You can see we've got a little bit of cyclical activity, and then we break into a downtrend. We break below a support level here, an important support level. We're in a downtrend. Pull back to end of trend. Another break below a support level, pull back to dirty end of trend, and so on. You can see the majority of the painting kind of going on in this lower time frame is all white bars. So that means we're below resistance and we're below support levels. So we've broken into a downtrend. Now, as soon as we kind of broken into a downtrend on this lower time trend chart, and then we reach a support level on the daily time frame, initially that support level kind of holds, and then it gets broken. You can see it starts to break into a trend move on this way down, and then next time frame up, same thing. we break below a support level here, we're in a downtrend here, and it's a support level on the monthly chart here, and we're kind of breaking down. What's going on is we start a small little, it's almost like, snowball. Snowball starts to kind of gather pace, gain momentum and so on. We start breaking these support levels on these lower time frames, then it gets picked up in the next highest time frame, and then the next highest time frame, and the next highest time frame, and you're into a big trend move when this just continues on. And once we've broken into these higher time frames, in order to stop this move, you need to see pullback to end of trend moves in these higher time frames. So this thing is not over until we see pullback to end of trend on the monthly chart, because we've broken into a trend move on the monthly chart with all this activity kind of going on. So obviously there's going to be a lot of volatility as we go on, but the strength of this move, the direction of this move, will be a downtrend in the yen until I would see a pullback to an end of trend. So that's what the yen's been doing, and I'm just using that as an example because it's been a really strong trend. It's been going on for a while. We've also had the same thing happen in the pound. And the pound's been breaking into a downtrend basically since mid-January. So again, same kind of thing, 460-minute chart, daily, weekly, monthly, and so on. And so, we had this low time frame, intraday time frame, max out with a pullback to end of trend move here, and this is where we start to break into a downtrend at 150 on this time frame. We broke into a downtrend, pull back to end of trend, a little bit of cyclical activity, break into another downtrend, pull back to, we haven't had a dirty end of trend signal yet here. But as soon as we were kind of breaking through that 150, it was also on the daily chart around that time. It was also a support level on the daily time frame. We broke into that, and you can see downtrend here. It was a cyclical resistance on the weekly chart, so we already had kind of weakness because we were kind of moving down through this cycle up here at 162. So we had this cycle move kind of behind us. We've now put in a cyclical support on the weekly chart, and because the trend move is still going on the daily chart, if the support level on the weekly chart gets hit, we kind of head through that. We'll need to see pullback to end of trend on the weekly chart before this is over. And you can see on the monthly chart, same deal. We've got a resistance line just like this printed up at these highs at 62 that was kind of going in our favor, in effect, showing us that the move was, the cycle energy on these higher time frames was to the downside. And as soon as these started breaking into trend moves on the way down, they're going to continue until we find support in these time frames. And if the support in these time frames does not hold, we'll kind of keep going down until we find those pullback to end of trend moves on these higher time frames. So it's just a useful way of seeing kind of trend moves percolate through from the lowest up to the highest time frames on trend moves. And once they start developing into trend moves on these higher time frames, they're going to keep going until we see pullback to end of trend on those higher time frames. You can use exactly the same kind of thing with the 3 time frames, with like 500, 1500, 4500 tip bar charts on daily E-mini trading and so on. Doesn't matter what kind of time frames. All I'm suggesting is use multiple kind of time frames, use better sine wave and breaks of these levels of support and resistance into trend moves. When they start to percolate through, that's what you want to get on board, kind of strong trend moves like that. Now, the reason for talking about dollar index is that over this weekend I just thought that there seemed to be a lot of discussion about the US dollar, and there's a couple of kind of themes kind of going on at the moment in terms of the investing world, and they're kind of polar opposites. One is this point of view where we're going to break into hyperinflation, gold's going to go through the roof, and the US dollar is going to fall through the floor. And Peter Schiff is kind of one of the guys that kind of is behind the logic here. He's been very consistent over the last couple of years, just talking up gold, talking down the US dollar, saying in our future there's going to be hyperinflation and so on. And Schiff's a good guy. I like him a lot. I mean, he sat through years and years of criticism and pain when he was talking about how the housing bubble was going to end in disaster, and he was on the money, absolutely right. He's been right in terms of the weakness of the US dollar. If you look at the dollar index over the last several years, it has been pretty weak. He's suggesting it's going to go even weaker and so on. He could be right. He might be right in the long term. He might not be right in kind of the medium term, but he kind of represents one kind of point of view. Another point of view is Jim Rickards with his book on currency Wars, which I read, which I loved. The guy's very, very smart. Again, I have huge respect for all these people. Rickards is kind of more talks about the bullish case for the euro. He's saying that the eurozone is starting to sort out its problems, and it'll be a stronger currency kind of going forward once it finds its kind of bottom over the next short while and so on. He's kind of by extension, he's kind of bearish on the US dollar, but he's saying the Europeans are actually facing their problems and sorting out their problems, and therefore he's kind of bullish on the euro. On the other side of things, we've got Martin Armstrong over at Armstrong Economics, and he had a good piece this weekend. I'll put a link up to this, just talking about how everybody is kind of really bearish on the US dollar and expecting hyperinflation and higher gold prices and so on. He's kind of the reverse of that. He's saying no, we're into a deflationary environment. Although we've got money printing, QE happening in the US, it's not happening as fast as the destruction of capital and the writing off of debt and writing down of debt and kind of coming out of the system. So in effect, the money supply is not going up, and we're actually in a deflationary kind of environment. So he's saying that's bullish for the dollar and is kind of bearish for gold and so on. So we've got kind of different kind of points going on. My particular point of view is, as I kind of sit with Armstrong Economics, from what I see from the charts, I see that we're going to break into dollar strength kind of going forward. And so I'm just going to show you what I can see on my charts. And I've been pretty consistent, I think, on this picture in terms of the last year and a half and so on. My trading capital has been stuck in US dollars. I've missed out on a little bit of rally in the Aussie dollar, admittedly, but I've been quite happy kind of holding on to US dollars. But again, let's look at this in terms of better sine wave and why this week's activity was really kind of critical. So same kind of deal with different time frames. It's a 440-minute chart here. Again, 3 times that gives us the total minutes kind of traded on the daily session of the dollar index here. So 440 minutes at the lowest time frame. Then we go up to a daily chart, a weekly chart, and a monthly chart, and so on. Now, although the trend moves in the pound and the yen have started kind of months ago, and they're kind of in full swing at the moment, what we've had over the last month really is this kind of, for me, it's a really important kind of break into strength in the dollar index. And you can see, we're basing over the last 2 or 3 months here in the dollar index, and then with the move in February, we've had this breakout into a trend move. So we've had the first little trend move, or a pullback to end of trend move on the 440-minute chart, and then looking at that on the daily chart, we've broken into an uptrend here above 81 here. The resistance on the daily chart got broken. We've kind of kept going. We've tried to find it before. Previously we kind of broke above it, but this got caught by resistance on higher time frames, and we kind of head back down, test a couple of times, and this time we got a decent break on the daily chart. We're a fair ways above resistance on the daily chart, and so this is going to go pull back to end of trend. And this week's activity, this is why this week was really interesting for me, and why I'm kind of recording this video today, is that on the weekly chart you can see we've had the first resistance in a while kind of print. Now if I just scrunch up this chart a little bit, the last times we've come in, we've been at higher levels previously on the weekly chart with dollar index, and we've had resistance kind of come in, but we didn't break above it this time, kind of at the end of 2011. Coming into the beginning of 2012, again, we didn't break above it. Mid 2012, you can see we did fractionally kind of break above it. We kind of couldn't really close above it. We kind of come back down. This time we've got these kind of trend moves behind us that could easily just propel us through this kind of 83.5 level up to 84 on the weekly chart. And as soon as we start doing that on the weekly chart, all of a sudden, as I say, these trend moves propagate from these low time frames through these medium to high time frames. And once we're into these high time frames, the thing will go and go until we see pullback to end of trend, and we could be surprised by the strength in the US dollar. On the monthly chart, again, the thing that's been holding us back is there is resistance level that's printed over the last year and a half here, and we're above this again. We tried it before, breaking above it, couldn't get through it, come back down, find support at 80, and we're back through it at 83. So we're above resistance on the monthly chart. We're coming up to a resistance on the weekly chart. Breaks above this, closes above this over the next following 2-3 weeks, would confirm that we're in an uptrend on the dollar index. So just watch out for that. And again, trend moves percolate from lower time frames into higher time frames, and they keep going until we see these pullback to end of trend on the higher time frames. Now, I thought I'd do some kind of back history on. I always talk about keeping your capital in the strongest currency possible, and just thought I'd look back and see, well, what if you'd done that in the last 10 or 20 years? What would your performance have look like? So you go back on TradeStation. The earliest I can get data is back to 71 for the dollar index. So I've just plotted up here. This is the S&P 500 since 71, and this is the dollar index since 71. It's on a log chart on the S&P 500 index, just because that makes sense with an index, so that you can have consistent kind of percentage moves look like kind of linear moves on a log chart. And you can see that we've done quite nicely. The index back in 71 was sitting around 100, and the index is now up in the 1500s, and so that's a compound growth of about just under 7% over that, what is that, 40 year kind of 40 odd year kind of time period, kind of a 7% compound annual growth rate there. In the meantime, what the dollar index has done is it sat around, I think, about 120 at the beginning of 70s, and it's now down at 83. So there's been about a 30% decline in the dollar index. But just let's say, for sake of argument, if you're able to short the US dollar over this time period into 1980, and then into 86 you kind of were long the US dollar, and then down into about 93 you were short US dollar, long, short, and so on. You kind of get the picture. What would be the comparable compound growth rate that you get in your capital? And it works out to be almost exactly the same, about a 7% capital gain. Now, if you had the prescience to be invested in equities and be able to ride this move since the 70s, you'd have done about a 7% compound annual growth rate. And if you were able to hit the highs and the lows of the dollar index over the same time period, you'd also have reached about the same amount of capital appreciation, about a 7% per annum capital appreciation. I'm not suggesting that you do this, or even if that were possible, but what I'm saying is there's as much to be had in getting the currency right as there is getting the market right. So don't ignore the moves in the currency. You need to be aware of the moves in the currency. You need to be in strong currencies. Keep your trading capital in strong currencies, invested in strong currencies, because you can easily destroy a good move in a particular market with being in the wrong currency. And I'd suggest at the moment, we've got the equities markets in Japan, racing away. However, the yen is falling through the floor. So the net of that might be zero. Whatever you're getting on the equities market on the upside, you're kind of destroying with the currency on the downside. The trick is to be able to find markets with the two kind of things kind of going on. But obviously, there's as much in the currency as there is in the market. If you can, kind of get these general broad trends kind of correct. And then just going back to what's actually been going on in the US dollar, and these are kind of 7 to 10 year type moves in the currency. So again, going back to the 70s into 79, 80, we had a real decline in the US dollar. We had all kinds of problems in the developed worlds. We was looking at stagflation. We had a couple of oil crises during that time, and the economy was pretty wretched in the US. And then come 80, 81, we got Ronald Reagan kind of comes in. Reagan comes in with Reaganomics, basically reduces the tax rates and makes a business-friendly environment, and we get a doubling in the US dollar as the capital flows into the US economy and kind of invests in the strength of what's going on there. Come 85, 86, the next trend that we see is decline in the US, and what was going on here was basically the rise of Japan. So we had huge concern in the US that the Japanese were going to take over the world, their GDP was going to rise faster, be biggest economy in the world, blah blah blah. I remember being in Pittsburgh at the time, and you'd go into you'd be afraid if you had a Japanese car to park it in a public car park, because you'd find a brick through the windscreen coming back at the end of the day. And this was a very sad time for the US, as it was viewed as a declining economy. And then mid-90s we have the tech boom. Tech boom starts to kind of get going, and into 2000, 2002 you can see here all the capital again kind of flowing into the US, into all the tech opportunities, NASDAQ and so on. Since then, the US dollar, with a couple of blips, we had a blip in 2008 with the financial crisis, but it's been on the way down. The dollar index has kind of been on the way down, and that's been a couple of things. First of all, there's been money printing by the Fed ever since 9/11, and it's also been kind of better opportunities in commodity markets and emerging markets kind of around the world, and so the money's not been flowing into the US, it's been flowing out of the US. But what you can see is these kind of not generational, but they're kind of mega trends that are kind of going on here. They last between 7 and 10 years, and we put in 10 years of declining US dollars, and we've been forming this bottom down here in the 80s, and we're starting to break into uptrends. So could we be looking at the next, if you're kind of plotting low here is about 2007 in the US dollar, maybe a 10-year kind of 2007 to 2017 kind of strength in the US dollar. So for the next foreseeable for maybe 5 years or so, we could actually have one of these kind of mega trends in the US dollar, and it could be setting up with these kind of smaller time frames kind of breaking into these higher time frames. And just to put that in context, this is just going back to 2000. I've put this chart up a couple of times, just showing what the other currencies are doing. And it's kind of sad that most of the currencies around the world are either too small or they're fixed versus pegged versus other currencies. The number of tradable currencies in the world is only about 5 major currencies. We've got a whole bunch of tiny little currencies. We've got New Zealand dollar, we've got Turkish lira, we've got Czech kronas, we've got Danish kronas, we've got Norwegian kronas. All of these things, they're little mini kind of currencies. What we've got left is basically the euro, which is here in blue. We've got the Swiss franc again, which used to be separate, but after the runaway Swiss franc, they're kind of pegged together. So effectively, the Swiss franc and the euro are pegged together until that peg breaks, and all hell breaks loose in the Swiss franc. We've got the Aussie dollar. I know you're probably thinking, well, Aussie dollar, surely that's a microcurrency, but it's not. It's actually, I think it's the 4th largest trading currency in the world. Kind of high beta. It's one of those kind of trading vehicles that's kind of a bit of a favourite of the FX traders. So we've got the Aussie dollar here. We've got the British pound here in red, which, as an ex-Englishman, is kind of really sad. I mean, the pound peaked in 1901, basically, and has been down ever since, and we kind of, continue to go down. It's kind of sitting at parity compared to what it was back in 2000. We've got the pound, we've got the Canadian dollar, which I think is this one here. Yep, the loonie. So in purple here, kind of going on, not dissimilar to the Aussie dollar because they're both kind of commodity-based currencies. Aussie dollar is more reflective of what's going on in the Asian economies. The loonie is more kind of reflective of what's going on in the US economy, but they're more kind of commodity-based currencies. They've been kind of the weakest of the lot. Then we've got the yen, kind of here. You can see over the last, as I was saying, since October, this has been in a real decline. And then the net of all of that is the dollar index. So, over this time period, we've had a couple of blips up. 2008, with the rush back into safety, the strength in the US dollar kind of came in, and then we've been just gradually basing since 2011 in this dollar index, and you can see all these other currencies have come off the boil. So we've got the Swiss francs down kind of big time, the Aussie weakened a little bit. It's the strongest of the lot, I'd suggest, kind of on this kind of chart. The loonies starting to weaken, the pound starting to break into downtrends, the yen is that's the euro starting to break into downtrends, the yen's definitely heading down, and the pound's kind of heading down. So if this starts to break significantly the other way, and all of a sudden these currencies start to move in entirely the opposite directions, we could be seeing a secular type move in the trends of the dollar index. And then lastly, just look at these better indicators on the daily, weekly and monthly time frames. And on the monthly time frame into 2011, 2012, you can see exhaustion selling and bullish divergence has come in the end of 2012 into 2013. Amateur down bars here, so low trading activity kind of selling the market down here. We've had our professionals pick it up, we've had our exhaustion selling the down move in the dollar index, and this is a testing back down. We've broken back up and we're above resistance on the weekly chart, on the monthly chart. On the weekly chart you can see here kind of less selling going on. The professionals picked it up at the lows down here at 80. We've come back up, we're starting to trend through, maybe break above this weekly resistance. And then on the daily chart, we've broken into an uptrend here at the beginning of this year. We're above 81. We've had this exhaustion buying kind of setting the move off, but this thing isn't over till pull back to end of trend. And if we break through the weekly resistance, we'll be into a trend move on this time frame, and that's got to play itself out. So there we go, a little bit of a discussion. I don't know how long I've run this video, apologies, a bit long for you, but just want to talk about using your multiple time frames, better sine wave indicator and breaks of support and resistance to indicate trend moves. And for the time being, what I see going on is strength in the US dollar. So, and we've got, where else can you park your money at the moment? We've got the yen, in a lot of trouble. It's say capital flight out of Japan. We got the pound started to weaken as well this year, and that's kind of heading down. And so there's capital flight out of the UK. We had some strength in the euro at the beginning of the year, but a lot of that could be just repatriation of funds, banks fixing up their balance sheets and so on. And the news out of Cyprus over the last 10 days has been pretty dire, and people are saying, well, is it safe to have my money invested in the eurozone? Who knows what's going to happen to the euro, the currency, and who knows, where the investment opportunities are. So, if those opportunities, big opportunities, kind of are over, you've got pegged currencies elsewhere. The renminbi, the Hong Kong dollar, the Singapore dollar, and so on, are all pretty pegged currencies. Maybe the money, yes, is flowing into the Asian markets, I suggest, but at the moment, from what I see, it's also flowing into the US. And so the US is kind of the beneficiary of all of that flight to safety, because if you look around the world, it's pretty uncertain what's going on. So we'll see how this turns out. Who's going to be right at the end of the day, whether it's going to be Martin Armstrong, whether it's going to be Jim Rickards, whether it's going to be Peter Schiff. I don't know. My personal opinion is what I see in the charts is we're breaking into a pretty big bull move on the dollar index. And if you've been following the site for any period of time, I've been pretty consistent on that point of view over the last almost year and a half now. So hope your trading is going well. Hope you're enjoying your weekend, and looking forward to next week.